UK Tax Podcast, Tax Aspects of UK Corporate Demergers, with John Kavanagh.
Welcome back to the UK Tax Podcast. My name is John Kavanagh and I am a chartered tax advisor with my own private practice. I mainly advise other professional advisors, but also private and business clients. I've been working in tax for 40 years and have been a chartered tax advisor for well over 30 years, so I hope this podcast will offer something useful. Today I want to talk about demergers and in particular how they're treated for tax purposes in the UK. A demerger is a way of separating different businesses or parts of a group into independent ownership. The reasons are often commercial. Perhaps a family wants to divide a company between siblings, or the shareholders wish to isolate different business lines for succession planning or sale. Structurally, a demerger involves one company or group transferring a business or asset to another company, and then that company being passed to the shareholders. There are three main types of demerger used in the UK, and each of them works differently from a tax perspective. The three types are statutory demergers, capital reduction demergers, and reconstructions by liquidation, commonly known as liquidation demergers. Firstly, let's talk about statutory demergers. A statutory demerger is only possible where both the distributing company and the business being demerged are trading. That means companies that carry on any investment activity, such as holding let property or a share portfolio, for example, won't be able to use this demerger route. In a statutory demerger, a trading company or holding company with distributable reserves transfers part of its business into a subsidiary and then distributes the shares in that subsidiary to its own shareholders. That distribution must be made lawfully out of accumulated profits under company law, so it's essential to confirm the company has sufficient reserves. The lack of distributable reserves will necessitate a different approach. The attraction of the statutory demerger method is that the distribution of subsidiary shares is not treated as a dividend for tax purposes. It's not taxed as income on the shareholders, and provided other conditions are met, the transaction can be structured so there's no capital gains tax at that point either. The original shareholding is effectively split between the old company and the new one, and the shareholders continue to own both companies directly. The downside of the statutory route is that it's inflexible. It can't be used where any investment activity is involved, even if that investment is only a small part of the business. It also requires that the shareholdings in the two businesses remain in the same proportions, and it doesn't allow for any cash to be taken out of the business as part of the transaction. But where the conditions are met, this is usually the cleanest and most straightforward route to implement. If the statutory route isn't available because of investment activity or because the company doesn't have distributable reserves, then a capital reduction demerger may be used instead. In this structure, a new holding company is inserted above the original company, and the business to be demerged is moved into a new subsidiary. The holding company then reduces its capital and distributes the shares in that new subsidiary to the shareholders. From a tax perspective, the aim is to avoid the distribution being treated as income. That usually means the distribution must be made out of capital, not profits, and that it isn't part of a scheme designed to return value to the shareholders. Where those conditions are met, the distribution may fall outside the definition of an income distribution for tax purposes. In particular, the general rule that a distribution of shares in a subsidiary constitutes an income distribution is disapplied, where the distribution is made otherwise than out of distributable reserves and does not form part of a tax avoidance arrangement. These are the conditions that underpin what is commonly referred to as an exempt distribution in this context. The capital reduction demerger method is clearly more flexible than a statutory demerger because it can be used where the business includes investment assets, and it can also accommodate situations where the post-demerger ownership isn't necessarily in the same proportions as in the original company. It's often used in family businesses, for example, where different children will take over different parts of the group, or where some shareholders want to exit and others want to carry on. But it is also more technically complex and demanding. The company law procedures must be followed exactly. The reduction of capital must be properly documented, and the accounting treatment must be consistent with the legal form of the transaction. The third route is to use a liquidation reconstruction. This involves placing the existing company into members' voluntary liquidation and transferring its business into two or more new companies. The shares in those new companies are then distributed to the shareholders by the liquidator. This is sometimes referred to as a Section 110 demerger, after the relevant provision of the Insolvency Act. Liquidation reconstructions are typically used where the company is a single legal entity and doesn't already hold its assets or activities in separate subsidiaries. They can also be used where a clean break is needed or where investment activity is involved. The aim is to achieve capital treatment for the shareholders and to avoid income tax on the value transferred. As with the other methods, there are tax reliefs available that can prevent capital gains tax being triggered on the transfer of the business to the new companies. The shareholders will normally be treated as having exchanged their shares in the old company for shares in the new ones, and the base cost of their original shares is apportioned between the new holdings. This route is particularly useful where the demerger is part of a winding up or simplification process, or where other options aren't available due to the structure or activities of the company. It's also often used in investment businesses or in companies with mixed trading and investment activities that don't meet the conditions for a statutory or capital reduction demerger. For instance, a statutory demerger is only available where both the distributing company and the demerged company are trading, which excludes companies that hold significant investment assets such as buy-to-let property or long-term equity holdings. Similarly, a capital reduction demerger may be ruled out where the distribution cannot be structured otherwise than out of capital, for example because of accounting treatment, legal constraints, or commercial pressure to preserve capital balances. In these situations, a reconstruction via liquidation may be the only practical way to achieve separation while accessing the available tax reliefs. Regardless of the demerger method used, there are a number of tax issues that need to be addressed carefully. One is the possibility of an income tax charge on shareholders under the Transactions in Securities rules. Her Majesty's Revenue and Customs may challenge the transaction on this basis if it sees the arrangement as one that extracts value in a form intended to secure a tax advantage. In particular, a demerger that allows a shareholder to convert what would otherwise be income into capital may be recharacterized, leading to an income tax charge at dividend rates. A statutory clearance procedure is available, and in practice it is standard to apply for advance clearance in all but the most straightforward intra-family transactions. The application for clearance must fully explain the commercial rationale, set out the steps in the transaction, and include confirmation that no tax avoidance purpose is involved. Stamp duty, and where land and buildings are involved, SDLT also need to be considered. Transfers of shares as part of a reconstruction may qualify for exemption from stamp duty, but only where all statutory conditions are met. Where property is being transferred within the group as part of the demerger, SDLT group relief will often be available, provided the companies involved are within the same group and the relevant conditions are met. However, that relief can be clawed back if one of the companies leaves the group within 3 years of the transaction. This clawback risk also applies where the property was transferred within the group before the demerger takes place. So if a property was moved into a different group company as part of pre-demerger planning, and the company that now holds it later leaves the group, the SDLT saved on the original transfer may become payable. Future plans for the structure need to be carefully considered and documented to manage this risk. For VAT purposes, where a business or part of a business is transferred from one company to another as part of the demerger, the transaction may qualify as a transfer of a going concern. If so, it falls outside the scope of VAT. This avoids triggering an output tax charge and can preserve the recipient company's entitlement to input tax recovery. However, TOGC treatment depends on whether the assets transferred constitute a business in themselves, whether the transferee is VAT registered and intends to continue the same kind of business, and whether all the relevant conditions are met. Particular care is needed where property is involved, especially if it is opted to tax, or where the recipient is partly exempt. While this podcast episode mainly deals with the tax aspects of demergers, it's also extremely important to understand the legal requirements, which can be highly procedural and must be properly followed. In a capital reduction demerger, for example, the Companies Act allows a private company to reduce its share capital by passing a special resolution and making a solvency statement signed by all directors. That statement must confirm that the company can meet its debts as they fall due for the following 12 months. If the solvency statement is not properly made, the capital reduction is invalid and the entire demerger may fail. In the case of a public company, court approval is required unless a re-registration as a private company is undertaken first. Similarly, any share-for-share exchange or issue of new shares must comply with the company's articles and the statutory preemption rules unless validly disapplied. Where shares are issued in exchange for assets or in connection with a reconstruction, the requirements of sections 550 and 551 of the Companies Act on Directors' Authority may also come into play. In a section 110 liquidation demerger, the appointment of a licensed insolvency practitioner, proper board resolutions, and notice to creditors are all mandatory steps. The liquidator's authority to effect distributions in specie must be clear and supported by the company's articles or by resolution. Care also needs to be taken over shareholder approval. Demergers typically require special resolutions and in some cases unanimous consent, particularly where rights of minority shareholders could be affected. Where different share classes exist, class meetings may be required. In some cases, particularly family-owned businesses, formal shareholder agreements may need to be amended or terminated before the demerger is implemented. Finally, care must be taken where the demerger is connected with a future sale or exit. Her Majesty's Revenue and Customs may take the view that the transaction forms part of a wider arrangement to extract value and challenge the availability of reliefs, or argue that a chargeable event has occurred. It's vital to document the commercial reasons for the demerger and to ensure the implementation is robust both legally and fiscally. To summarise, demergers are a powerful tool for separating business activities and achieving structural flexibility, but the tax and legal rules are technical and unforgiving. Statutory demergers are clean and efficient, but only available to trading companies with sufficient reserves. Capital reduction demergers offer more flexibility, but require more careful structuring and documentation. Liquidation reconstructions are often used where neither of the first two routes is available, particularly in the case of investment businesses or single company structures. Whichever route is used, professional input is essential, and HMRC clearance should almost always be sought before implementation. I'm John Kavanagh, and I'd like to thank you for listening to this episode of the UK Tax Podcast. More episodes are on the way, and I very much hope you will join me again for the next and future episodes.